Our rating breakdown report for the second quarter 2014, best and worst ETFs and mutual funds by style, will show you exactly how our predictive rating system provides the predictive capabilities that we offer. It's a rating system based on holdings and costs, not past price performance and cost. We're here to help you understand the underlying earnings quality and profitability of the stocks held by mutual funds and ETFs, so you can make a much more informed decision about the kind of risk and reward you expect from mutual funds. Figure 1 shows my top rated funds by my overall predictive rating by each style. And for example, my top rated fund in the all cap value style is the Sun America Focused Dividend Strategy Portfolio, ticker FDSWX. I like it because it holds good stocks like Eli Lilly, where we've seen 8% compounded annual growth in profit over the last 9 years, while it has a valuation with a price to economic book value ratio of 0.9, which implies that the current market price thinks that Eli Lilly's profits will permanently decline by 10%. Figure 2 shows the worst ETFs and mutual funds in each style. Not surprisingly, this figure is dominated by mutual funds. They tend to almost always have worse ratings than ETFs because their costs are higher. One of the worst rated funds in the all-cap blend style is the NISA fund, ticker NYSAX. And it gets a bad rating because it allocates to stocks like dry ships, ticker DRYS, where we've seen an 18% compounded annual decline in NOPAT since 2008. All the same, the stock price at $3 implies the company's profits are going to grow at 20% compounded annually for 12 years. Bad risk reward. Bad funds hold bad stocks. Good funds hold good stocks. It's just that simple. And we're here to provide you the research to be able to understand which funds hold the good stocks and the bad stocks. Figure 3 is a breakdown of the best funds, ETFs and mutual funds, by what we call our portfolio management rating, which is the quality of holdings. And you can see the top all-cap blend fund is the Hennessy Cornerstone Large Cap Growth Fund. The small cap growth, the best rated small cap growth fund, unfortunately just gets a neutral rating. That's the Virtus Small Cap Core Fund. Figure 4 shows the funds and ETFs with the lowest quality holdings. And there's a wide variety of ETFs and mutual funds here, but in large cap value, it's the 360 Fund Snow Capital Focused Value Fund. And you can see by going through that figure exactly which are the worst ETFs and funds by style. Figure 5 shows the worst ETFs and funds by costs. The best by costs, the cheapest of them all. And surprisingly, there's at least a few mutual funds on here. In fact, more mutual funds than ETFs. Typically, ETFs are cheaper than mutual funds, but a lot of times you don't see ETFs by investment style, and so by default you're dealing with a mutual fund. Again, figure 5 will show you those with the lowest cost, and figure 6 shows the ETFs and mutual funds with the highest cost. Not surprisingly, this is a figure dominated by mutual funds, and all of these mutual funds are going to get a very dangerous rating as well, because typically if they're the most expensive, they're extremely expensive. Some of these guys are charging 5, 6, 7, 8, 9% compounded annually when you take into account all costs.